Hey guys, I just want to kind of like share what I've discovered, or not really discovered. I just want to share some of my portfolio experiment in the US stock market, particularly in Ray Dalio's portfolio. I just wanted to find if there are some portfolio that can do better than Ray Dalio, especially when it comes to like a bear market. Okay, and this is actually what I found. So this one. So for this parameter, for this strategy or strategies that I found, I actually backtested it from around like was it February 1, 2007 up to August 31 of 2019 of last year. And the initial balance is going to be $10,000 USD. So let's actually keep things realistic. So periodic adjustment none, and then we only gonna rebalance it once a year. And let's say that we're not gonna reinvest any dividend, so no. And we're gonna compare it with the SPY benchmark, see if we could do significantly better than this one. So yeah, so we're only gonna make money from capital gains or capital appreciation here. And here's the first portfolio that I found. Note that this is not an investment advice. I'm just experimenting, like if I could find any portfolio that can do slightly better than Ray Dalio. And turns out it is. Yes, so here's one of them. So let's simply call it the ETF Portfolio 1 with the following tickers and allocation. So in this case, I'm only allocating money on ETFs. I'm not allocating any money on specific stocks. Okay. So let's move on. So this is like the modified version. So I just remove some of the tickers that has less like allocation and then try to renormalize it, and this is what I got. So let's call it the ETF Portfolio 2. Okay. And this is Ray Dalio's all-weather portfolio. Take note that this thing, I only got it from a website called Portfolio Visualizer, which I would actually put the link in the description box. Okay. And then I actually tested this portfolio live using a different website called Wall Street Survivor, which I would also put a link in the subscription. So let's move on. Ray Dalio, and this is the performance. As you can see, looking at the compound annual growth rate here, did I outperform Ray Dalio? Yes, very much so. That was awesome. That was my maximum drawdown. Although I didn't beat Ray Dalio in terms of drawdown. I just beat Ray Dalio in terms of just the return. But not on the drawdown. I think it would be nice if I could still minimize this one. Yes. Awesome. But now we got the Sharpe ratio. Oh, this is actually what I'm trying to say. Mine has like a higher Sharpe ratio than both Ray Dalio and the SPY ETF. Spider S&P 500 ETF. That's awesome. But the downside here is that I actually I am or my portfolio are more correlated to the market than Ray Dalio. So that is actually not a good news for us. But you know, I mean, it's not extremely high, like close to 90%. So that's fine in here. But I think we could do better though. So here's the equity curves of the portfolio growth for both ETF1 and ETF2. So the modified ETF2 and Ray Dalio's and the SPY. So as you can see in 2008, so the SPY suffered a drawdown of 50%. Whereas the Ray Dalio in my ETF is actually performed normal, I guess. I think it lost money. I mean, we'll see it in the returns, in the monthly return later. But as you can see here, the two ETF portfolio that I found actually performed like better than Ray Dalio, which is the green one. Like from the year around 2007 to 2019, the SPY managed to outperform Ray Dalio's portfolio here. Okay, and look at the annual return, and look at this back in 2008 financial crisis for the SPY. That's a huge one. So I guess out of all this strategy, I think Ray Dalio performed better though in in the 2008 financial crisis. He actually did make some money there. And my ETF portfolio didn't, it lost, but at least I managed to kind of like reduce the drawdown when it comes to adverse kind of event like the 2008 financial crisis. Okay. And then 2013 is actually kind of like the start of the bull market here for the S&P 500. And here's the metrics and other metrics that we could see. So, yeah. You could have a pause and then try to analyze the difference. And here's the return. So, of the first portfolio, the ETF portfolio that I found, the only time I suffered here was back in 2008 financial crisis with a loss of 1.56%. Okay, that's awesome. So ETF portfolio 1 with arithmetic mean or annualized average return of 10%. That's good. And then ETF portfolio 2 is slightly better with 11.01% return, annualized arithmetic mean. But what about the other metric that we could use? Like, for example, compound annual growth rate. Not really sure where it is, but yeah, I think we could just look at this one. What about the annualized volatility? 8%. 8.21 for ETF portfolio 2. It's a little bit more aggressive here. Yeah. Awesome. So this is the portfolio, the return of portfolio 2. This is Ray Dalio. So Ray Dalio suffered from 2015 and 2018. Okay. 3% is pretty large compared to the one I suffered from 2008 financial crisis. So 2015, 3%. Okay. And this is the drawdown. And the rolling returns, the decomposition, etc. Okay, so now the picture that we're looking at is the kind of like the live paper trading for the ETF portfolio 2, where we only have 6 tickers here, which are IAU, IEF, JKE, PSJ, TLH, and TLT. So I believe the capital or the virtual money that I'm using here is only $100,000, and I think I started doing the backtest I think last year around November. I'm not exactly sure when I did it, but I'm sure it was last year, late last year, and this is kind of like the current performance right now. For IAU, it's like it's up 7.76% this year, I guess. And then for IEF is 1.35, JKE 15.65, PSJ 5.55, TLH around 2.13%, and TLT around 3.15%. And these blurred tickers here are kind of like some of the tickers that I found to be quite trendy. But I'm not gonna tell what it is, so I'll keep it private. But this is the important ones here for discussion. The ETF portfolio 2 ticker and their performance this year. So I guess they're performing well for 2020. So take note, I'm not actually making any investment advice. I'm just testing the ETF portfolios here. Especially the ETF portfolio 2, since it has less number of ticker and it was a little bit optimal than the ETF portfolio 1.